So this is wealth transfer tax issues dealing with property ownership. The way that we own property affects what goes into gross estate or what goes into taxable gifts, these different aspects. Now, there's really 5 different ways that property can be owned that are important to analyze with respect to the federal estate and federal gift tax. So these 5 types. We've got joint tenancy, also known as joint tenancy for right of survivorship, tenancy by the entirety, tenancy in common, community property, or fee simple. The best way to understand these differences, along with what happens with respect to gross estate, we're going to do some similar examples involving lemon and lime. We're going to change around some facts, change around the different type of ownership. We're going to go through each of these types in order. Now, this is meant to be a basic discussion. This is not meant to be advanced. Again, if you change the concepts, you change what's going on, it could change the facts, the analysis, the solution significantly. So we're just going through some basic understanding, some ideas. So let's start with joint tenancy. So joint tenancy, also known as, again, joint tenancy of right of survivorship, a type of concurrent ownership, so multiple people own, where if an owner dies, the owner's interest in the property will pass to the surviving owner or owners by operation of law. The idea is, let's say you have 2 owners, A and B, joint tenants, both are joint tenants. When A dies, A's interest goes directly to B, even if A wants it to go to somebody else. Under law, as joint tenants, it goes to goes to B. Once B acquires A's interest, B now has a fee simple absolute because fee simple absolute, only one owner owns everything directly. So again, this ownership cannot be transferred to a designated heir. We're going to see tenancy in common, that's different. And the last owner living gets what's called a fee simple absolute. They can do whatever they want with it. So let's go through a quick example. And again, the examples we're dealing with all kind of involve the same situation. Example 1, so in year 1, Lemon purchases land for $180,000 and took title of Lime as joint tenants of right of survivorship. Lemon and Lime are not married. Has Lemon made a completed gift to Lime, and if so, in what amount? So yes, when Lemon purchases the land and makes Lime a joint tenant with Lemon, there is a gift made because Lime has not contributed anything. And the idea is that you take one half of the amount because they're assumed to be one half owners. With joint tenancy, theoretically, each owner owns a property outright, but they're all considered equal owners. So joint tenancy, always equal. Keep that in mind. Tenancy in common, that can be different. So we take one half of $180,000 purchase price. That means there's a $90,000 gift made by Lemon to Lime. So Lemon would have to fill out Form 709 for $90,000 for that year. Now note, because they're not married, there is not going to be any marital deduction. No gift tax marital deduction is allowed. Let's consider example 2. And again, they all relate to previous examples. In year 1, Lemon purchased land for $180,000 and took title of Lime as joint tenants of right of survivorship. Lemon and Lime are not married. What if instead of purchasing the land, Lemon put this $180,000 in bank account, so it's not land, it's a bank account, with Lime as joint tenants of right of survivorship. Lemon and Lime are not married. So example 1, Lemon buys $180,000 of land, makes Lime joint tenant along with Lemon. Now we're changing around the facts and we're saying, well, what if Lemon just puts $180,000 in a bank account, same $180,000? Does that affect things? They're both joint tenants. It does. There's no transfer there's no gift on the transfer. There is no gift on the transfer. The idea here is, well, let's say that Lime doesn't take out any money and then Lime dies the next day. Has Lime gotten any benefit of that? No. Lime has not used the property or done anything that Lime wanted of the money. That's different from the land because as soon as Lime is an owner in the land, Lime has a bundle of rights Lime can do with the property, exclude people from property, or rent the property out, do whatever Lime wants, even if Lime doesn't actually use those property rights. But with money in a bank account, it's different because think about it. Lime has not actually withdrawn anything. So the rule, it's a special rule for bank accounts. The idea is that comparative example 1, again, there's this bundle of sticks in the land. Here, there's money that hasn't been withdrawn. So it's more fungible and easy to actually see the difference. Whenever Lime takes out money, there is a gift to Lemon. So as Lime withdraws money, now Lemon has gift. So the next day, Lime could withdraw $108,000 because remember, Lime, joint tenant, has the ability to control the property however Lime wants. Well, now Lime has taken out all the money, so now Lemon has made a gift of $108,000. So the rule for bank accounts for joint tenants is whenever property is withdrawn, cash is withdrawn, that is therefore going to be a gift. Let's go on to example 3. So just like example 1, where Lemon and Lime, they purchased land. Now instead of Lemon buying the land outright for $108,000, Lemon pays $140,000 and Lime pays $40,000. So in example 1, we had Lemon buying the entire amount. Remember, we took 1/2 of $108,000. That equals $90,000. That's the amount of gift. Well, here we apply the same rationale because, again, it's joint tenants. So joint tenants are both viewed to be 1/2 owners, theoretically, right, in terms of the purchasing, what should be contributed, even though theoretically they're also whole owners. So what we do is, well, Lime should have paid $90,000, but Lime only paid $40,000. That means that $50,000 was contributed by Lemon, and that is the amount of the gift. So Lemon's gift is $50,000. Now note that we're told in the problem they're not married, so again, there's no marital deduction allowed. So Lemon has a $50,000 gift on the Form 709. Now example 4, we've got Lemon purchasing land for $108,000, joint tenants right of survivorship. Again, Lemon and Lime are not married. What happens if Lemon dies in year 5 and the land is worth $200,000 in year 5? While still owning the property as joint tenants with Lime. How much of this land, if any, is included in Lemon's gross estate? The answer for joint tenancy, because we're going to see this differs in the future, in later examples, is the full $200,000 value is in Lemon's gross estate. So for joint tenancy, if they're unmarried, the full value is included in the decedent's gross estate. Therefore, the full value of joint tenancy property is included in Lemon's gross estate. This would even be the case for Lime if Lime died before Lemon in year 5, as Lime would have to include $200,000 in Lime's gross estate. So what I'm saying is if we changed around example 4 and said, what if Lime died before Lemon? Well, Lime would have to include that $200,000, assuming Lime died in year 5, in Lime's gross estate. Again, they're not married, so there's no deduction allowed. Now we go tenancy by the entirety. Tenancy by the entirety is pretty quick to explain. We just talked about joint tenancy. Tenancy by the entirety is, think of joint tenancy, but you have spouses married. Spouse is married. That's the key difference. So let's go through some examples now. So example 5, in year 1, Lemon purchased land for $108,000 as joint tenants with right of survivorship. And as I mentioned, joint tenants with right of survivorship, if you're married, is considered tenancy by entirety. In most states, it treats it that way. Has Lemon made a completed gift to Lime, and if so, what is the amount? Yes. The completed gift is again going to be the $90,000, just like we saw in example 1, same calculation. But the key difference is that now, since they're married, it's going to be $90,000 included in Lemon's gifts minus $90,000 deduction because of the marital deduction, gift tax marital deduction. Also $90,000, which balances out to 0. But that's how it'll be reported. Now, as I mentioned, most states automatically treat joint tenancy by survivorship with married couples as automatically tenancy by entirety, but other states you have to designate it, so it does make a difference. Example 6, what if you have Lemon purchasing the land for $180,000, Lemon and Lime are married, right? They're both joint tenants of right of survivorship. Lemon dies in year 5. What happens now? Well, we saw earlier when you had joint tenants, the full amount was included. When you're married, we have a different result. We take 50%, right? Because you have husband and wife, or spouses, I should say, right? Spouse and spouse. 50% of the value, the $200,000, that equals $100,000, that's included in Lemon's gross estate. Now, just like the gift tax, the estate tax also allows a marital deduction. And that marital deduction is going to be $100,000, the amount that's transferred. So we'd have $100,000 in gross estate minus a marital deduction for $100,000. That brings it down to zero, so it would net out to zero. Let's now move on to tenancy in common. So tenancy in common is very different than tenancy by the entirety and joint tenancy. Tenancy in common, you have different owners with different shares. They're all different co-owners. They own different share sizes, but the key is that the ownership can be transferred to a designated heir, which is not the case with joint tenancy or tenancy by entirety where it transfers to the other owners. So you can designate who you want to go to. Now I should note that with some ownership, like let's say you have a partnership, if it's tenancy in common, your ownership interest, the heirs just can't become partners. There's probably something in the partnership agreement that disallows that. But the partnership is allowed to maybe buy the heir's ownership interest. Okay? So this transfer usually does not avoid probate because many transfers go through will or intestate. So joint tenancy and tenancy by the entirety, they do avoid probate. That was mentioned on previous slides, which means it's not going to have to be fight or contested over when it comes to after the decedent's death. That saves lots of legal fees. But tenancy in common does, because you have to figure out, okay, well, the heir and is it legit and all that stuff. So it's important to note that, again, I mentioned earlier that there might be limitations on this with respect to someone actually being an owner. So let's go through some tenancy in common examples. You can read through all this and what happens, with division. Tenancy in common, you are allowed to, division of property is allowed. One owner can simply split the property if they want. The other ones, that's not the case. So example 7, Lemon purchases the land for $108,000 and took title of Lime as equal tenants in common. So that means it's 1/2, 1/2. You can designate the ownership of tenants in common. So they're saying 1/2, 1/2 equal. Has Lemon made a complete gift to Lime? Yes. And guess what? It's the same answer as example 1. Because Lime's getting 1/2, we take 1/2 of $108,000. Lime should have contributed $90,000. Lemon contributed that, so Lemon has a gift of $90,000. They're not married, so there's no marital deduction allowed. Okay, example 8. In year 1, Lemon and Lime purchased land for $108,000. What if Lemon pays $140,000 and Lime paid $40,000? Is it a complete gift to Lime? And if so, in what amount? So this is the same as the previous problem we saw. We remember $108,000 times 1/2 is $90,000. So Lime should contribute $90,000. Lime contributes $40,000. So that means that the $50,000 amount is contributed by Lemon, and that $50,000 amount is going to be a gift to Lemon. So that's the same result we saw when it was a joint tenancy. And again, there's no marital deduction allowed. What if Lemon purchased land for $108,000 in example 9, took title of Lime as equal tenants in common, and then Lemon dies in year 5 when the land is worth $200,000? Again, they're 1/2 owners, right? Well, now, this is different than when it's a joint tenancy. When it's joint tenancy, the full $200,000 is included in Lemon's gross estate. Now, we do the ownership percentage. We take the $200,000 times the 50% ownership, and it's $100,000. So $100,000 is included in Lemon's gross estate, and there's no estate tax marital deduction because they're not married. So notice, when you go back through these examples, that when it's a joint tenancy, they're not married. It was $200,000 in Lemon's gross estate. When they were married, joint tenancy, they were married, treated by tenancy by the entirety. It was $100,000 in gross estate, but then $100,000 marital deduction, so it really netted to zero. And then finally, when it was tenancy by the entirety, 1/2 ownership, it was only $100,000. So it makes a big difference, right? It makes a big difference how you own it. Let's finish up just talking about community property and fee simple. Community property is a simple idea. Each spouse owns equal amounts. So if one spouse is making $5 million a year, the other spouse stays at home with the kids, then you split everything, $2.5 million, $2.5 million. So community property would just split everything equally between the spouses. Some states follow this. Mostly, I have a list down here. Spanish or French influence, they follow community property, but most states do not. Fee simple absolute, this just means that if there's only one owner of property, it's no longer concurrent ownership with multiple owners. It becomes fee simple absolute. They can do whatever they want. So if a joint tenancy, tenancy by the entirety, tenancy in common, only one owner is left, it becomes fee simple absolute, and they can do whatever they want. They can then transfer it to whoever they want going forward, do whatever they want with it. And that concludes property ownership and how it affects gift and estate tax.